I need to tell you something that most people don't want to hear. The dollar you're holding is going to be worth significantly less in 5 years than it is today. Not a little less, significantly less. And I'm not talking about the normal 2 or 3% inflation that the Federal Reserve targets. I'm talking about real, destructive inflation that erodes purchasing power at rates we haven't seen since the 1970s. Or worse, we're on a path toward hyperinflation. And most people have no idea what's coming. They think the government has everything under control. They think the Federal Reserve knows what it's doing. They think their savings are safe in dollars. They're wrong. The mathematics of our fiscal situation are impossible. We have over $35 trillion in federal debt. We're running deficits of $2 trillion per year in peacetime, during economic expansion. The unfunded liabilities for Social Security and Medicare exceed $100 trillion. There is no politically feasible way to fix this through spending cuts or tax increases. The only way out is monetary debasement, inflation, printing money to pay the bills. And when that happens, when the Federal Reserve is forced to monetize government debt on a massive scale, the value of the dollar will collapse. Your savings will evaporate. Your purchasing power will vanish. Everything priced in dollars will become worthless. Unless you own real assets, hard assets, commodities that can't be printed or created out of thin air. Today, I'm going to tell you about the 3 commodities I'm buying right now to protect against what's coming. These aren't speculative bets. These aren't gambles on price movements. These are insurance policies against the monetary chaos that I see unfolding over the next 5 to 10 years. But before I tell you what I'm buying, let me explain how I came to understand the mechanics of hyperinflation and currency collapse. Because this isn't theoretical. This has happened dozens of times throughout history, and it's about to happen again. I became obsessed with monetary history during the 2008 financial crisis. Everyone was focused on housing prices and mortgage defaults and bank failures, but I was looking at something deeper. The Federal Reserve's response. In 2008 and 2009, the Fed cut interest rates to 0. They started buying government bonds and mortgage securities directly. They created trillions of dollars out of thin air and injected them into the financial system. This was unprecedented. Never in American history had we seen monetary expansion on this scale. And I started asking myself, what are the consequences? What happens when you create this much money? I started reading everything I could find about past episodes of monetary expansion and inflation. I studied the German hyperinflation of the 1920s. I studied the Hungarian hyperinflation after World War II. I studied Zimbabwe in the 2000s. I studied Venezuela in the 2010s. And I found patterns, consistent patterns that appear in every single case of hyperinflation. It always starts the same way. A government faces fiscal crisis. Maybe it's war debt. Maybe it's economic collapse. Maybe it's political dysfunction and unsustainable spending promises. But the result is always the same. The government needs to spend more money than it can raise through taxes. So it borrows. At first, the borrowing is manageable. Investors buy government bonds. The debt markets function normally. But at some point, the debt becomes so large that investors lose confidence. They worry about repayment. They demand higher interest rates to compensate for the risk. And higher interest rates make the debt problem worse. Because now, the government is paying more in interest, which means it needs to borrow even more, which makes investors even more worried, which pushes rates even higher. This is a debt spiral, and there are only 2 ways out: default or inflate. Governments almost never choose default, because default means admitting failure. It means legal consequences. It means angry bondholders and international condemnation. So instead, they choose inflation. They instruct the central bank to print money and buy government bonds. This allows the government to keep spending. The central bank creates money, the government spends it, and the bond market is artificially supported because the central bank is buying. Problem solved, right? Wrong. Because creating money doesn't create real wealth. You can print currency, but you can't print goods and services. You can't print food or energy or housing. And when you dramatically increase the money supply without increasing the real productive capacity of the economy, you get inflation. Too much money chasing too few goods. Prices rise. In the early stages, the government denies there's a problem. They say inflation is transitory. They say it's caused by temporary supply chain issues or greedy corporations or whatever excuse seems plausible. They implement price controls. They subsidize certain goods. They manipulate official statistics to make inflation look lower than it really is. But reality can't be hidden forever. People see prices rising in grocery stores, at gas stations, in rent payments. They feel their purchasing power declining, and they start to lose faith in the currency. Once faith is lost, hyperinflation accelerates. People start spending money as fast as they receive it because they know it will be worth less tomorrow. This increased velocity of money makes inflation worse. Businesses raise prices preemptively because they know costs will rise. Workers demand higher wages to keep up with prices. A feedback loop develops where inflation expectations become self-fulfilling. The government prints more money to try to keep up with rising prices. But printing more money just makes inflation worse. They're trapped in a vicious cycle that ends only when the currency becomes completely worthless and has to be replaced. This happened in Germany in 1923. The paper mark that had been stable for decades became so worthless that people used it as wallpaper or burned it for heat because it was cheaper than buying firewood. It happened in Zimbabwe in 2008. The Zimbabwe dollar that had been equal to the US dollar at independence in 1980 eventually required 100 trillion Zimbabwe dollars to buy a loaf of bread. I studied these cases obsessively. I read the accounts of people who lived through these hyperinflations. And I learned that the people who survived, who preserved their wealth, were the ones who owned real assets: gold, land, commodities, things that had intrinsic value independent of the currency. When I look at the United States today, I see all the same warning signs. We have massive government debt that's growing exponentially. We have deficits that can't be closed through spending cuts or tax increases. We have a Federal Reserve that has already demonstrated its willingness to print unlimited money to support government borrowing. We have inflation that's already running well above the 2% target and shows no signs of returning to normal levels sustainably. We have a political system that's completely dysfunctional and unable to address the fiscal crisis. And we have a population that's largely unaware of what's coming because they trust that the government and the Federal Reserve will somehow fix everything. They won't. They can't. The mathematics don't work. And when people finally realize this, when confidence in the dollar begins to crack, the descent into high inflation or even hyperinflation could happen very quickly. This is why I'm buying commodities. Not as a speculation, not to make a quick profit, but as insurance. As a way to preserve wealth when paper currency becomes unreliable. Let me be clear about something. I'm not predicting hyperinflation next month or even next year. These processes take time. They unfold over years, sometimes decades. But the trajectory is clear. We're on the path. And the time to prepare is now, before everyone else figures it out and commodity prices spike. So what am I buying? What commodities offer the best protection against monetary debasement and currency collapse? I've identified 3 that stand out based on historical precedent, fundamental supply-demand dynamics, and their essential role in the economy. The first commodity I'm buying is silver. Not gold, though I own that too. Silver. And I'm going to explain exactly why silver is potentially more valuable than gold as a hyperinflation hedge. Most people think of gold as the ultimate inflation hedge. And they're not wrong. Gold has been money for 5,000 years. It's portable, divisible, durable, and scarce. It's the classic store of value during times of currency crisis. But silver has some unique properties that make it potentially even more valuable in a hyperinflationary environment. First, silver is both a monetary metal and an industrial metal. It has all the same monetary properties as gold. It's been used as money throughout history. It's recognized globally as valuable. It can't be printed or created easily. But unlike gold, silver also has extensive industrial applications. It's used in electronics, solar panels, medical devices, batteries, water purification, photography, and dozens of other industrial processes. This dual nature creates unique supply-demand dynamics. When investors buy gold, they're competing mainly with other investors and with jewelry demand. When investors buy silver, they're competing with industrial users who need silver for production. This puts a floor under silver demand that doesn't exist for gold. Even if investor demand wanes, industrial demand continues. Second, the silver market is much smaller than the gold market. The total value of all above-ground silver is a fraction of the total value of all above-ground gold. This means that when capital flows into silver, it moves the price much more dramatically than equivalent capital flows into gold. In inflationary environments, when people are fleeing currency and seeking hard assets, this smaller market size amplifies gains. Third, the gold to silver ratio is historically out of whack. Throughout most of monetary history, silver has traded at a ratio of somewhere between 10 to 1 and 20 to 1 relative to gold. Meaning if gold was worth $100, silver was worth somewhere between $5 and $10. But today, the ratio is more like 80 to 1. Silver is historically cheap relative to gold. This suggests that silver is either dramatically undervalued or gold is overvalued. My analysis suggests it's the former. Fourth, silver supply is constrained in ways that people don't appreciate. Most silver is mined as a byproduct of other metals, like copper, lead, and zinc. Only about 30% of silver comes from primary silver mines. This means that silver supply doesn't respond quickly to price increases the way you might expect. If silver prices double, it doesn't cause a surge of new silver mining because most silver miners are actually copper or zinc miners who happen to produce some silver as well. Their mining decisions are based on the primary metal, not the byproduct. Meanwhile, demand for silver is growing. Industrial demand is increasing as electronics proliferate and solar panel installation expands. Solar panels use significant amounts of silver, and global solar capacity is growing exponentially as countries try to meet climate goals. Investment demand is also increasing as more people recognize inflation risks. And then there's the supply-demand deficit. For several years now, the silver market has been in deficit, meaning annual demand exceeds annual mine supply. The gap has been filled by above-ground inventories, but those inventories are being drawn down. At some point, the inventories will be depleted and prices will have to rise to balance the market. When you combine all these factors, monetary properties, plus industrial demand, plus small market size, plus favorable ratio to gold, plus supply constraints, plus growing demand, silver looks like one of the most compelling commodity plays available. In a hyperinflationary scenario, silver would benefit from the same flight to hard assets that benefits gold, but it would likely outperform gold due to the factors I've mentioned. And even if we don't get full hyperinflation, even if we just get sustained high inflation of 5 or 10% annually, silver is undervalued at current prices. I've been accumulating physical silver, not silver ETFs or silver mining stocks, though I own some of those as well. Physical silver coins and bars that I can hold and store securely. Because in a true currency crisis, you want to own the actual metal, not a paper claim on metal that might be held in a vault somewhere that you can't access. Let me tell you why this matters so much. During the 2008 financial crisis, there were moments when the paper silver market completely disconnected from the physical silver market. The price on paper was $20 per ounce, but you couldn't actually buy physical silver at that price. Dealers were sold out. Premiums spiked to 30 or 40% above spot price. People who owned SLV shares couldn't convert them to actual metal. They just had a number on a screen. But the people who owned physical silver, they had real wealth they could touch and control. This is the difference between paper claims and physical ownership. In a crisis, paper claims can fail. Counterparties can default. Systems can freeze. But if you're holding a 1-ounce silver coin in your hand, you own it. Nobody can take it away through some accounting maneuver or legal technicality. The other advantage of physical silver is denominations. Gold is expensive. 1 ounce of gold costs over $2,000. If you need to use it for transactions or exchange it for goods, that's a very large unit. You're not going to shave off a piece of your gold coin to buy groceries. But silver trades at around $25 to $30 per ounce. Much more practical for smaller transactions. You can use a silver coin to buy a week's worth of food, to pay for a tank of gas, to exchange for services. If society breaks down to the point where we're using precious metals for commerce, and I'm not saying that will happen, but if it does, silver is more useful than gold for everyday purchases. This is actually what happened throughout history when currencies collapsed. In Weimar Germany, people used silver coins for everyday transactions because the paper marks were worthless. In Argentina, during their currency crises, people hoarded silver and used it for barter. The practical divisibility of silver makes it functional money in ways that gold can't match. Now let me talk about the quality and form of silver you should buy. This matters more than people realize. American silver eagles are the most recognizable and liquid silver coins. They're produced by the U.S. Mint. Everyone knows them. Everyone accepts them. The premium over spot price is higher, usually $3 or $4 per coin, but that premium is worth it for the liquidity and recognition. Canadian maple leafs are the second best option. They're also government minted, highly recognizable, and widely accepted. The premium is slightly lower than eagles. Then you have generic rounds and bars. These are produced by private mints. The premiums are lower, sometimes just $1 or $2 over spot price, but they're less liquid. If you need to sell quickly, you might get less for a generic round than for an eagle. I own a mix, mostly eagles and maple leafs for liquidity. Some generic rounds and bars for lower cost accumulation. I avoid anything that's not clearly marked with weight and purity. I avoid rare or collectible coins because you're paying for numismatic value that might not hold up in a crisis. Storage is another critical consideration. You can't just throw silver coins in a drawer and forget about them. They're valuable. They can be stolen. You need a plan. I keep some at home in a good safe, enough to be useful in an emergency, but not so much that losing it would be devastating, maybe 20 or 30 ounces. The rest I keep in bank safety deposit boxes at multiple banks. This diversifies the risk. If one bank fails or there's a bank holiday, I have access to metal at other locations. And I keep a portion in allocated storage at professional precious metals depositories. These are facilities specifically designed for storing gold and silver. They're insured, they're audited, and you own specific numbered bars, not just a claim on a pool of metal. The allocated part is critical. Unallocated storage means the facility holds a pool of metal and you have a claim on a portion of it, but you don't own specific bars. And if there's a problem, if the facility fails, or if there's a run on withdrawals, you might not be able to get your metal out. With allocated storage, you own specific bars with specific serial numbers. If you want to withdraw, they give you your exact bars. Much safer. The cost of all this storage and insurance adds up. It's probably 1 to 2% per year of the value of the silver, but that's the price of security, and it's far cheaper than the potential loss from theft or confiscation. I'm not putting my entire portfolio into silver. That would be reckless. But I'm holding a significant position, maybe 10 to 15% of my liquid net worth in physical silver, and I'm prepared to hold it for years or even decades until the monetary crisis I'm anticipating unfolds. Because here's what people don't understand about silver. It's not just an inflation hedge. It's a complete systemic crisis hedge. If the banking system freezes, if credit cards stop working, if ATMs shut down, if the dollar becomes worthless overnight, I have silver. I can use it for transactions. I can use it to preserve wealth. I can use it to survive economically when paper-based systems fail. That's insurance worth paying for. The second commodity I'm buying is oil. Specifically, I'm buying oil through a combination of physical oil exposure via funds, energy stocks, and oil futures when the curve is in backwardation and the roll yield is positive. Oil is essential to modern civilization in ways that most people don't fully appreciate. Everything runs on oil. Transportation, manufacturing, agriculture, chemicals, plastics, pharmaceuticals. You can't replace oil quickly or easily. The energy density of petroleum is unmatched. The infrastructure built around oil represents trillions of dollars of capital investment that can't be easily repurposed. In an inflationary environment, oil is one of the first commodities to spike. Why? Because transportation costs affect everything. When oil prices rise, the cost of moving goods rises. The cost of commuting rises. The cost of producing food rises because modern agriculture is heavily dependent on diesel fuel for machinery and natural gas for fertilizer. These rising costs feed through to all other prices, creating a cascading inflationary effect. In a hyperinflationary environment, oil becomes even more critical. People need energy. They need to heat their homes, power their vehicles, run their businesses, and as currency becomes worthless, they'll pay any amount of rapidly devaluing currency to get the oil they need. This is what happened in Venezuela. As the bolivar collapsed, gasoline prices in bolivars went to astronomical levels. The government tried to control prices, which just created shortages. The people who had access to gasoline, who could store it or trade it, They had real power and real wealth even as the official currency became worthless. The same pattern played out in Zimbabwe, in Weimar Germany, in every hyperinflation. Energy is essential, and oil is the most important form of energy we have. Now, you might say, what about the transition to renewable energy? What about electric vehicles? Won't that reduce oil demand and make oil less valuable? Those are fair questions. And yes, over a multi-decade time frame, oil demand will likely peak and then decline as we transition to other energy sources. But that transition is going to take much longer than most people think. The world currently consumes over 100 million barrels of oil per day. We have over 1 billion cars on the road, almost all of which run on gasoline or diesel. We have hundreds of thousands of planes that run on jet fuel. We have massive shipping fleets that run on diesel and bunker fuel. All of this infrastructure can't be replaced overnight. Even with aggressive policies to promote electric vehicles, even with massive investment in renewable energy, oil demand is likely to remain strong for at least the next 10 to 20 years. And during that period, supply is going to be constrained. Why? Because the industry has been underinvesting for years. When oil crashed in 2014 and 2015, companies cut exploration and development budgets. When it crashed again during COVID, they cut even more. Now, ESG pressure makes it difficult to finance new oil projects. Banks don't want to lend to oil companies. Investors don't want to fund exploration. Politicians create regulatory obstacles. This underinvestment means that new supply isn't coming online fast enough to replace declining production from existing fields. Most oil fields are in natural decline. Once you start pumping oil out of the ground, the production rate decreases over time. To maintain flat production, you need to keep developing new fields to offset the decline from old fields. But that's not happening at the pace it needs to. The result is a tightening market. Demand is still growing, driven by developing countries. Supply is constrained. And when you have rising demand and constrained supply, prices go up. In an inflationary environment, this dynamic accelerates. As the currency loses value, oil producers demand more units of currency for each barrel. And buyers have to pay because they need the oil. This creates a feedback loop where oil prices rise in nominal terms far faster than inflation in general. During the 1970s, oil prices increased tenfold from about $3 per barrel at the start of the decade to over $30 per barrel by the end. This wasn't just inflation. This was oil repricing relative to a weakening currency. I expect to see something similar over the next decade. Oil at $150 or $200 per barrel is not just possible, but likely if we enter a high inflation or hyperinflationary environment. And at that price, the companies producing oil and the people holding oil assets will see enormous appreciation in real terms. My oil exposure is diversified across multiple approaches. I own shares in major integrated oil companies like ExxonMobil and Chevron. These companies own reserves in the ground, refining capacity, and distribution networks. In an inflationary environment, these hard assets appreciate while generating cash flow from operations. I own shares in smaller exploration and production companies that are pure plays on oil prices. When oil spikes, these stocks can return multiples. I own oil services companies that provide equipment and expertise to the drilling industry. As oil prices rise and drilling activity increases, these companies see their revenues and profits expand. And I have exposure to physical oil through commodity funds that hold actual crude oil or oil futures. This gives me direct exposure to the oil price without having to worry about company-specific risks. The beautiful thing about oil as an inflation hedge is that it's not just about price appreciation. The oil companies I own are paying dividends. They're buying back stock. They're generating cash flow. Even if oil prices stay flat, I'm earning returns. And if oil prices spike the way I expect, the returns will be extraordinary. Oil is also globally traded and priced in dollars. If the dollar weakens, oil prices in dollar terms have to rise to compensate producers. This makes oil a natural hedge against dollar debasement, specifically, not just inflation in general. Let me dig deeper into why oil is uniquely positioned for the environment I see coming. The petrodollar system has been a cornerstone of American economic power since the 1970s. After Nixon took the dollar off the gold standard in 1971, the U.S. made a deal with Saudi Arabia and other oil-producing nations. They would price oil in dollars and recycle their oil revenues into U.S. Treasury bonds. In exchange, the U.S. would provide military protection and support. This created structural demand for dollars. Every country that needed to buy oil, which is basically every country, needed to hold dollars. This supported the dollar's value and allowed the U.S. to run persistent trade deficits without the currency collapsing. But that system is breaking down. China has been working for years to create alternatives to dollar-based oil trading. They've established yuan-denominated oil contracts. They're making deals with oil producers to accept payment in yuan or other currencies. Russia, after being sanctioned and cut off from dollar markets, has been selling oil for rubles or in barter arrangements. Saudi Arabia, the linchpin of the petrodollar system, has been warming up to China and discussing non-dollar oil sales. If the petrodollar system collapses, if oil starts trading in multiple currencies instead of primarily in dollars, the implications are enormous. The structural demand for dollars would decline. The U.S. would have to pay higher interest rates to attract buyers for Treasury bonds. The Federal Reserve would have to print even more money to fund government spending. And oil prices in dollar terms would have to rise to compensate producers for the dollar's declining value. This is a slow-moving process. It won't happen overnight. But the trend is clear. The dollar's monopoly on oil pricing is eroding. And as that happens, oil becomes an even more important hedge for dollar holders. Another aspect of oil that most people miss is the energy return on energy invested, or EROEI. In the early days of the oil industry, you could drill a well in Texas or Pennsylvania with minimal effort and get massive amounts of oil. The energy you had to invest to extract the oil was tiny compared to the energy you got from burning the oil. That's a high EROEI. As the easy oil has been depleted, EROEI has declined. Offshore drilling requires huge amounts of energy to build platforms, drill deep wells, and transport oil back to shore. Shale oil requires hydraulic fracturing, which is energy intensive. Tar sands require massive amounts of heat to separate the bitumen from the sand. All of these sources have lower EROEI than conventional oil. What this means is that it takes more and more energy to produce new energy. And that cost shows up in the price. The marginal cost of new oil production is much higher than it was 50 or 100 years ago. This puts a floor under oil prices. Even if demand were to drop, which I don't think it will anytime soon, prices couldn't fall below the cost of production without shutting in supply. And the cost of production keeps rising due to declining ROAI. I've also been looking at the Strategic Petroleum Reserve, the SPR. The United States government maintains a reserve of oil in underground caverns to provide supply during emergencies. During 2022 and 2023, the Biden administration released over 200 million barrels from the SPR to try to control gasoline prices. This was the largest SPR release in history. It helped keep prices down temporarily, but now the reserve has been drawn down to levels not seen since the 1980s. The government says they want to refill the SPR, but at current oil prices, that's expensive. If they try to buy large quantities to refill, they'll push prices higher. If they don't refill, they've lost a strategic buffer against supply disruptions. Either way, it's bullish for oil. If they buy to refill, that's additional demand supporting prices. If they don't refill, the next supply shock will be worse because there's no reserve to draw on. My oil positions are structured to benefit from rising prices while generating income during periods of stable prices. The major integrated companies like Exxon and Chevron have diversified operations. They make money from drilling, from refining, from selling gasoline at retail. They're less volatile than pure upstream producers. The smaller exploration and production companies are higher risk, higher reward. They're levered plays on oil prices. If oil goes to $150, these stocks can triple or quadruple. But if oil drops to $50, they can lose 70% of their value. I size these positions accordingly. The oil services companies are a different play. As oil prices rise, drilling activity increases. Rigs get activated. Service companies that provide drilling equipment, expertise, and logistics see revenue growth. Companies like Schlumberger and Halliburton benefit from this. The commodity funds that hold oil futures require more active management. Oil futures have contango and backwardation dynamics that affect returns. When the curve is in contango, meaning future prices are higher than current prices, you lose money on the roll yield as near-term contracts expire and you have to buy more expensive, longer-dated contracts. When the curve is in backwardation, meaning future prices are lower than current prices, you gain on the roll yield. The United States Oil Fund and similar ETFs have struggled historically because they've often had to roll contracts in contango markets. You need to understand these mechanics before using these funds. Personally, I prefer direct commodity exposure through funds that hold physical oil in storage when possible, though that's not always practical for individual investors. The third commodity I'm buying is agricultural land and agricultural commodities. I talked about farmland earlier as a real asset play, but I want to dig deeper into why agricultural commodities specifically are critical in an inflationary or hyperinflationary environment. Food is non-negotiable. People can cut back on travel, on entertainment, on luxury goods, but they can't cut back on food. They need to eat. And in an inflationary environment, food prices are often the first to spike and the most visible to the general population. When people can't afford food, societies become unstable very quickly. This is why governments try to control food prices during inflationary crises. But price controls create shortages, and shortages make the crisis worse. The people who own food, who control agricultural land, who have stored grains or livestock, they have real wealth that can't be inflated away. Agricultural commodities have several unique properties that make them valuable in inflationary environments. First, production is constrained. You can't just decide to grow more wheat or corn overnight. It takes time. You need land, you need water, you need seed, you need fertilizer, you need equipment, you need farmers who know what they're doing. And all of those inputs are themselves scarce and subject to inflation. Second, agricultural commodities are perishable or semi-perishable. You can't stockpile fresh produce indefinitely. Even grains have limited storage life. This means that supply and demand have to balance continuously. You can't just rely on old inventory the way you might with metals or oil. Third, agricultural production is weather dependent. A bad growing season, a drought, a flood, a freeze, any of these can dramatically reduce yields and create price spikes. And climate change is making weather patterns less predictable and more extreme. Fourth, agricultural commodities are essential inputs for the broader economy. Corn is used for food, for livestock feed, for ethanol fuel. Soybeans are used for food, for animal feed, for biodiesel, for industrial applications. Wheat is a staple food globally. When agricultural commodity prices rise, they feed into food prices. They feed into energy prices through biofuels. They feed into meat and dairy prices because livestock eat grain. The inflationary impact ripples through the entire economy. In hyperinflationary environments, food prices often rise faster than the general price level because demand is completely inelastic. People will pay anything for food. They'll spend their entire paycheck if necessary. This was visible in Venezuela. As the Bolivar collapsed, food became the primary concern. People waited in line for hours to buy subsidized food. The black market for food flourished. Farmers who could grow food and sell it for hard currency or barter became wealthy relative to everyone else holding worthless bolivars. The same pattern appeared in Zimbabwe. Farmers with productive land were insulated from the currency collapse because they were producing real value that people needed. I'm exposed to agricultural commodities through several channels. I own farmland directly, which I lease to farmers. The land appreciates in value, and the rental income increases with crop prices. I own shares in agricultural companies, fertilizer companies, seed companies, equipment manufacturers, grain traders. These companies benefit from rising agricultural commodity prices and increasing farming activity. I hold positions in agricultural commodity funds that provide exposure to wheat, corn, soybeans, and other crops. And I'm looking at livestock as well, particularly cattle. The supply of cattle in the United States is at multi-decade lows due to drought in key regions and economic pressures on ranchers. Meanwhile, demand for beef is growing globally as developing countries get wealthier and consume more meat. This supply-demand imbalance could drive cattle and beef prices significantly higher. Agricultural commodities also have a geopolitical dimension. Food security is national security. Countries that can't feed their populations face unrest and instability. We've already seen this play out in the Arab Spring, where food price spikes contributed to revolutions across the Middle East. As climate change affects agricultural production, as water becomes scarcer, as arable land degrades, food security will become an even bigger issue. Countries will prioritize feeding their own populations over exporting food. This could lead to export restrictions, trade wars, and further price volatility. The United States is fortunate to be one of the world's largest agricultural producers. We have vast farmland, good soil, reliable water in many regions, advanced agricultural technology. In a world where food is scarce and valuable, American agricultural assets will be increasingly sought after. Another factor driving my interest in agricultural commodities is fertilizer. Modern agriculture depends heavily on nitrogen, phosphorus, and potassium fertilizers. These fertilizers are produced using natural gas for nitrogen and mine deposits for phosphorus and potassium. As energy prices rise, fertilizer prices rise. As phosphate and potash deposits are depleted, fertilizer becomes more expensive. This creates a cost push on agricultural production that ultimately shows up in food prices. I own positions in fertilizer companies. These are companies with access to potash deposits or phosphate rock or the natural gas and facilities needed to produce nitrogen fertilizer. In an inflationary environment where food prices are rising and farmers need to maximize yields, fertilizer demand will be strong and prices will be high. Companies like Nutrien, Mosaic, and CF Industries are positioned to benefit. These companies have hard assets, mines, processing facilities, distribution networks. In an inflationary environment, these physical assets appreciate in value while generating cash flow from operations. Let me give you specific examples of how agricultural inflation plays out, because it's not abstract. In 2007 and 2008, we had a global food crisis. Rice, wheat, and corn prices all spiked. Rice nearly tripled in price in a matter of months. There were food riots in over 30 countries. Governments imposed export restrictions to protect domestic supply. And the people who owned rice, who controlled rice production and distribution, made enormous profits. This wasn't hyperinflation of the currency. This was a supply-demand mismatch, combined with speculation and panic. But it showed how quickly food prices can spike and how valuable food assets become when people are scared about availability. In 2010 and 2011, we had another food price spike. This one was partly driven by droughts in Russia and Ukraine, which are major wheat exporters. Russia banned wheat exports. Prices spiked globally. The Arab Spring uprisings were partly triggered by bread prices doubling in countries like Egypt and Tunisia. Food inflation can topple governments. Now imagine a scenario where we have currency debasement on top of supply disruptions, where farmers are reluctant to sell crops for depreciating currency, where governments are printing money to subsidize food prices, which just makes inflation worse, where export restrictions proliferate as countries hoard food. This is what happens in hyperinflationary environments. And this is why owning agricultural production capacity, owning farmland, owning commodity exposure to wheat and corn and soybeans is so valuable. You're not dependent on a government that might fail or a currency that might collapse. You own the means of producing food. Let me talk about the specific agricultural commodities I'm focused on. Wheat is the most important. It's a staple food globally. Bread, pasta, noodles, all made from wheat. Over 70% of the world's population consumes wheat regularly. The global wheat market is tight. Inventories are low relative to consumption. Major exporters like Russia, Ukraine, Australia, and the United States dominate the market. Any disruption to supply from one of these regions causes price spikes, and with climate change causing more frequent droughts and floods, supply disruptions are becoming more common. Corn is second. It's used for food, for livestock feed, for ethanol production. The United States is by far the largest producer and exporter. Corn yields are sensitive to weather, particularly during the critical growing period in July and August. A hot, dry summer can reduce yields by 20 or 30%, and that translates directly into higher prices. Soybeans are third. They're used for cooking oil, for animal feed, for biodiesel, for dozens of industrial applications. China is the largest importer of soybeans, buying from the United States, Brazil, and Argentina. The US-China trade tensions have added volatility to this market, with China sometimes favoring Brazilian soybeans over American ones for political reasons. I have exposure to all three of these crops through commodity funds and through my farmland holdings. Some of my land is rented to farmers growing corn and soybeans. The rental income increases when crop prices are high because farmers can afford to pay more rent. Rice is another commodity I'm watching. It's the staple food for over half the world's population, primarily in Asia. the rice market is less globally integrated than wheat or corn. Most rice is consumed in the country where it's grown. But when rice prices spike, as they did in 2008, the impact on poor countries can be devastating. Sugar is interesting because it's both a food commodity and increasingly a biofuel feedstock. Brazil produces ethanol from sugarcane. When oil prices rise, demand for sugar ethanol rises, which supports sugar prices. So, sugar benefits both from food inflation and from energy inflation. Coffee and cocoa are smaller markets but worth mentioning. These are luxury commodities that people continue to consume even during economic hardship. Coffee especially has very inelastic demand. People need their coffee, and the supply is constrained by the fact that coffee plants take years to mature and production is concentrated in specific tropical regions. Cotton is an agricultural commodity with industrial applications. It's used for clothing, for textiles, for dozens of other products, like sugar. Cotton has an interesting dynamic where it competes for farmland with food crops. When food prices rise, farmers plant more corn or wheat and less cotton, which reduces cotton supply and pushes cotton prices higher. I don't have direct exposure to all of these commodities. I focus primarily on wheat, corn, soybeans, and fertilizer. But I monitor the broader agricultural complex because it all moves together during periods of agricultural inflation. Let me step back and explain how these three commodities work together as a portfolio hedge against hyperinflation. Silver provides monetary insurance. It's a store of value that preserves wealth when currency collapses. It's liquid and globally recognized. Oil provides energy security and economic exposure. It benefits from rising prices in nominal terms and from its essential role in the economy. Agricultural commodities provide food security and real asset exposure. They benefit from inelastic demand and supply constraints. Together, these three commodities cover the most basic human needs: store of value, energy, and food. In any inflationary or hyperinflationary scenario, these are the things that matter. Not stocks of companies that might or might not survive. Not bonds denominated in depreciating currency. Not cash that's losing value by the day. Real assets that have intrinsic value and meet fundamental needs. Now, I want to address the obvious question. How do you actually implement this? How do you buy these commodities? For silver, I buy physical coins and bars from reputable dealers. American Silver Eagles, Canadian Maple Leafs, generic rounds and bars. I store some at home in a safe, some in bank safety deposit boxes, and some in allocated storage facilities that specialize in precious metals. I avoid unallocated storage where you don't own specific bars, but rather have a claim on a pool of metal. I also own shares in silver mining companies and the SLV ETF, though I'm aware that the ETF is not the same as physical ownership. For oil, physical ownership is impractical for most people. You can't store barrels of crude in your garage. So I use a combination of energy stocks, oil services stocks, and commodity funds that hold oil futures or physical oil in storage facilities. The United States Oil Fund is one option, though you need to understand the mechanics of how these funds work and the costs involved in rolling futures contracts. For agricultural commodities, I own farmland directly, which gives me physical exposure to the asset class. I own agricultural stocks, and I use commodity funds that provide exposure to grain, livestock, and other agricultural products. The key is diversification within the theme. I'm not putting all my money into silver or all my money into oil. I'm spreading across all three commodities and using multiple approaches within each. This protects me if I'm wrong about the timing or if one commodity underperforms relative to the others. I'm also realistic about the timeline. Hyperinflation doesn't happen overnight. It builds gradually. The German hyperinflation took several years to fully develop. The Zimbabwe hyperinflation played out over nearly a decade. Even if I'm right about the trajectory, it could be 5 or 10 years before we see truly catastrophic currency debasement. That means I need to structure these positions so I'm not bleeding money while I wait. The silver sits in storage and costs me almost nothing to hold. The oil stocks pay dividends and buy back shares, generating returns even if oil prices stay flat. The farmland generates rental income and appreciates slowly over time. I'm not dependent on a specific catalyst or timeline. I'm positioned to benefit whenever the inflation I'm anticipating arrives, whether that's next year or in 10 years. And if I'm wrong, if somehow the government gets fiscal policy under control, if the Fed manages to engineer a soft landing and bring inflation back to 2% sustainably, if the dollar remains strong and stable, I haven't destroyed my portfolio. The commodities I own are fundamentally valuable assets that should hold their real value over time, even in a non-inflationary scenario. Let me talk about the risks, because there are always risks. Commodities are volatile. Silver can drop 30 or 40% in a matter of months. Oil can crash if there's a recession, or if supply unexpectedly surges. Agricultural commodities can collapse if we have several years of perfect weather and bumper crops. These are real possibilities. I'm not guaranteeing that these commodities will go up in value over any particular time frame. What I'm saying is that in an inflationary or hyperinflationary environment, these commodities are likely to preserve and grow purchasing power better than financial assets denominated in depreciating currency. There's also regulatory risk. Governments facing currency crises sometimes confiscate gold and silver. This happened in the United States in 1933 when FDR ordered citizens to turn in their gold. It could happen again. This is why I'm careful about how I hold these assets and why I maintain some positions outside the United States in jurisdictions that are less likely to implement confiscation. Singapore, Switzerland, and the Cayman Islands all have strong property rights and histories of respecting precious metals ownership even during global crises. I keep a portion of my silver in allocated storage in these jurisdictions. It costs more than domestic storage, but the additional security is worth it. There's storage risk with physical commodities. Silver can be stolen. It needs to be stored securely. Same with any physical asset. This is a cost and a hassle that doesn't exist with stocks or bonds. Professional storage with insurance might cost 1 to 2% of the asset value annually. That's a real expense that eats into returns. There's opportunity cost. The money I have in commodities isn't earning the returns I might get from stocks during a bull market. If the stock market goes up 20% next year and my commodities sit flat, I've underperformed. But I'm willing to accept that opportunity cost as the price of insurance, because if the currency crisis comes, if hyperinflation unfolds the way I expect, the commodities will more than make up for years of underperformance. I've run the scenarios. If inflation stays moderate, say 3 to 4% annually, my commodity positions might underperform a stock portfolio by 2 or 3% per year. Over 10 years, that's a significant difference. But if inflation accelerates to 10 or 15%, or if we get actual hyperinflation with prices doubling every year or faster, the commodity positions could outperform by multiples. The risk-reward asymmetry makes sense to me. Limited downside, significant upside. One more risk worth mentioning is that the inflation itself might not arrive on the timeline or in the form I'm expecting. Maybe the government implements massive spending cuts. Maybe productivity growth accelerates and increases real economic output enough to absorb the monetary expansion. Maybe artificial intelligence leads to massive deflation in goods and services that offsets the monetary inflation. Maybe something else happens that I haven't foreseen. I'm basing my analysis on historical patterns and current data, but the future is uncertain. I could be wrong about the timing, the magnitude, or even the basic thesis. I thought inflation would arrive sooner than it did after the 2008 crisis. The Fed printed trillions, and I expected to see high inflation by 2010 or 2011. Instead, it took over a decade. I was early. Being early in markets is the same as being wrong in terms of opportunity cost. So I'm humble about my ability to time this perfectly. That's why this is a hedge, not my entire portfolio. I'm not going all in on this inflation trade. I'm allocating a meaningful portion of my assets to these commodities, maybe 20 to 30% in total across silver, oil, and agricultural exposure, while maintaining diversification across other strategies and asset classes. I still own stocks. I still own cash. I even own some bonds, though very short duration only. The commodity positions are insurance. They're the part of my portfolio designed to survive and thrive if the worst-case scenario unfolds. If I'm wrong, if the dollar stays strong and inflation stays low, I'll underperform. But I'll survive. I won't be wiped out. That's the key to long-term investing. Survive first, optimize second. Make sure you can weather any scenario, then position for the scenario you think is most likely. Let me share one more historical example that shaped my thinking on this. I spent a lot of time studying the Roman Empire and its currency debasement. Rome started with a silver denarius that was 95% silver. Over centuries, emperors facing fiscal crises gradually reduced the silver content. They mixed in cheaper base metals. By the 3rd century AD, the denarius was less than 5% silver. This was ancient inflation. They couldn't print money, so they debased the coins. The effect was the same. The currency lost value, prices rose, people lost faith in the money, and the people who survived economically were the ones who owned real assets, land, commodities, things that had value independent of the official currency. The parallels to today are striking. We're not literally clipping coins, but we're doing the digital equivalent, creating money out of nothing, expanding the money supply far faster than real economic growth, debasing the currency through monetary policy instead of through physical adulteration of coins. And just like in Rome, the people who will survive are the ones who own real assets, not the ones holding currency or financial claims denominated in currency. This is a story that is repeated throughout human history. Every fiat currency eventually fails. Every government that spends beyond its means eventually debases its currency. And every time, the people who saw it coming and positioned themselves in hard assets preserved their wealth. I'm not smarter than anyone else. I'm just willing to look at the data, study history, and draw obvious conclusions. The United States is on an unsustainable fiscal path. The Federal Reserve has shown it will print unlimited money rather than allow a financial crisis or government default. The political system is incapable of addressing the underlying problems. These facts lead to one conclusion: currency debasement, inflation, and eventually, potentially, hyperinflation. When that happens, paper wealth will evaporate. Stock prices might rise in nominal terms, but they'll fall in real purchasing power terms. Bonds will be catastrophic, offering fixed payments in depreciating currency. Cash will be trash, losing value every day. But silver will preserve wealth. Oil will preserve wealth. Agricultural commodities will preserve wealth. These are the assets I'm buying. These are the 3 commodities I'm positioning in before hyperinflation. Not because I want to be right about a catastrophic economic outcome, but because the mathematics and history are too clear to ignore, and I'd rather be prepared and wrong than unprepared and right. The cost of being wrong is opportunity cost and some underperformance. The cost of being right but unprepared is the loss of everything. That's not a risk I'm willing to take. So I'm buying silver, I'm buying oil, I'm buying agricultural commodities, and I'm prepared to hold them for as long as it takes for the rest of the world to figure out what I already know. The dollar is going to lose significant value. Inflation is coming, and the only way to protect your wealth is to own things that can't be printed. That's the lesson of history. And I'm betting that history is about to repeat itself once again. I want to leave you with one final thought. The greatest wealth transfers in history have happened during periods of currency crisis and hyperinflation. In Weimar Germany, people who owned hard assets, who owned businesses and land and commodities, became fabulously wealthy in real terms, even as the currency collapsed. People who held cash or bonds or other paper assets were wiped out. In Zimbabwe, the farmers who owned productive land survived and even prospered, while everyone else holding Zimbabwe dollars lost everything. The same pattern played out in Venezuela, in Argentina, in Hungary after World War II, in every hyperinflation throughout history. This isn't about getting rich quick. This is about preserving wealth and being positioned on the right side of a massive wealth transfer that I believe is coming. The people who own real assets, who own commodities, who own things that have intrinsic value, they will preserve their purchasing power and likely see it grow. The people who hold paper assets, who trust in the dollar and the government and the Federal Reserve, they will be devastated. I don't want to be right about this. I would prefer that the government gets its fiscal house in order, that the Federal Reserve successfully navigates back to price stability, that the dollar remains strong and reliable. But I can't ignore the data. I can't ignore history. And I can't ignore the mathematics of our current situation. So I'm buying silver. I'm buying oil. I'm buying agricultural commodities. Not because I want hyperinflation, but because I'm prepared for it. And when it comes, I'll be on the right side of the greatest wealth transfer of our generation.